still talking about general intra-group transactions coming from chapter 4, a further question that should now be asked is whether these consolidation journal entries affects any closing balances in the consolidated financial statements, and whether these journals therefore needs to be repeated in the following financial year during the consolidation process, so that the opening balances in the following year are adjusted to be equal to the closing balances of the prior financial year. Remember, every year that you consolidate, your starting point is the separate financial statements of the parent and the subsidiary. If you had consolidation journal entries and consolidation adjustments that changed balances in a particular year, you'll have to repeat the effect of those consolidation journal entries in the subsequent year to repeat the effect and to get your opening balances in line with your prior year closing balances. Now, if you look at these 3 journal entries as an example, every time the debit and the credit goes to profit and loss for the same amount, the debit and the credit goes to profit and loss for the same amount, and profit and loss closes off to retained earnings. So what we can conclude is that both the debit and the credit leg of all of these journal entries closes off to retained earnings, and every time it's for the same amount. Therefore, retained earnings as a balance does not change as a result of these consolidation journal entries. And that makes sense, because these journal entries also didn't change the profit of the group. And if profit of the group doesn't change, retained earnings of the group would also not change. So the answer to the question is, if this is the intra-group consolidation journal entries you're working with, there will not be the need to repeat them in your subsequent year when you perform the consolidation process. What about this consolidation journal entry where we eliminated the intra-group loan? Do we have to repeat this consolidation journal entry in a following year? Well, it depends. This consolidation journal entry does change balances. It eliminates a liability and an asset from the consolidated financial statements. So yes, you will have to repeat that in subsequent years, but only if it's still a liability and an asset in the separate financial statements that you start with. If this intra-group loan has been settled, it will not be included in the separate financial statements, and then you will not have to repeat this consolidation journal entry. But the concept behind this decision depends on whether the intra-group consolidation journal entry changed balances in one particular year, and if that's the case, you'll have to repeat the effect thereof in a subsequent reporting period. The last bit of theory coming from chapter 4 before we look at the comprehensive example looks at bank and bank overdraft balances in a group situation. Now, a situation that could arise and does not truly represent an intra-group transaction is where one entity in the group has a positive or favorable bank balance, which is a current asset, and the other entity has a negative or unfavorable bank balance, being a current liability in its separate financial statements. The question arises whether these two amounts, the current asset and the current liability, may be netted off against each other and then be presented as a net amount in the consolidated statement of financial position. Now, the following criteria must be met before this offsetting is allowed. First of all, both entities should keep their bank account at the same financial institution. And, please note the and. there should be an agreement with this financial institution that the accounts may be offset against each other. And again, the group must have the intention to settle the accounts on a net basis or simultaneously. So have a look out for this in a question. If you have to prepare a consolidated statement of financial position and the one entity has a favorable bank balance and the other entity has an unfavorable bank balance, you are only allowed to show that and present that as a net amount in the consolidated SFP if all three of this criteria have been met. And it will have to be stated in a question for you to know whether it is applicable or not.